CFA calculator. You can download that calculator. You have the, you can open your Play Store and you can type CFA calculator and it is available. You can download. It is BA financial calculator. Isha, you can do that because we will be using calculator to do the calculations. Okay. So this is the next question. What we are doing, a fixed coupon bond. So fixed coupon bond is a bond which gives fixed interest to its investors. That means if you invest in fixed coupon bond, you can expect fixed interest every year if it is if the payments are done annually, or every 6 months if it is done semi-annually. It depends upon the frequency of the payments. Okay, so here let's say there's an example, a 3% annual coupon. So what is the difference between a coupon and a yield to maturity, or sometimes referred to as market interest rate? The difference is this is the agreed interest rate which company has agreed to make the payment to the bondholder, okay, or the lender, okay, and this is the expectation of the people who invest in similar kind of bonds in the market, okay. That is the market interest rate. So you should be knowing that this is one which can, with which you can find out the coupon payments, and this is the one which is used as a discount factor. Okay, that means your I by Y will be the discount factor, and your we say here PMT will be the coupon payment. So I will again repeat, that means these are the calculator functions. I will write it here. You should be following. See, always PV is the present value. PMT is the fixed coupon payments. FV is the future value. I by Y is the rate of return or discount factor in easy language. N is number of years or frequency of payments, whatever you want, you can put it as. Okay, so I have explained everything. Basically what they ask in the question, the data depends upon that, and accordingly you can try to find out. Come on, now the question goes in this way. Consider a 10-year $1,000 par value. Okay, so N is equal to 10. Okay, FV is equal to $1,000. This is always the amount which company would pay in the future. This is the liability for the company. Okay. Coupon rate is 10%. Discount factor is yield to maturity, that is I by Y is equal to 8%. So consider a 10-year bond. So 10 years is what here we have written. Consider a 10-year bond which has a par value of $1,000 and which is making a coupon payment of 10%. This is a annual paying bond, and the value of the bond, if its yield to maturity is 8,000. So what are they asking you? They are asking you PV. Am I right or wrong? Present value of the bond is what they are asking. Hello, are you following what I'm saying? That means for
Yes.
such kind of bond, what are you going to invest today? So shall we do the calculation? So you should be knowing bond price. Bond price is nothing but present value of future cash flows. So what are your future cash flows? Every year 10% of 1,000, that is $100 you will be getting. 1, 2, 3. That will be for a span of 10 years. But in the 10th year, you are also going to get $1,000. That is the repayment of that liability or the borrowing which company has made from the lenders. So you see here for 10 years $100, but for 9 years it is all $100. But in the 10th year it is $100 plus $1,000, which makes it 1,100. So you have to discount all these future cash flows. So first year it is 100 divided by 1.08, then 100 divided by 1.08 whole square, 100 divided by 1.08 whole cube, it goes on, and it is 1100 divided by 1.08 whole power 10, and you get the answer. So you can do with this method. Otherwise, n is equal to 10, PMT is equal to 100. Okay, PMT is the coupon, right? FV is 1000, I by Y is 8, and they are asking compute PV. You can get the answer. So you can take your calculator. In that calculator, second clear TVM function, and clear work you have to click. Then 10 you have to click. For n, 10 you have to type 10 and click on n. So n is equal to 10. Then you have to type 100 and then click on PMT. Okay, then you have to type 1000 and then click on FV. Then you have to type 8 and click on I by Y, and then you have to click on compute, and then you have to click on PV. You will get 1134.20. Since it is the investment you are doing for getting a redemption value of $1,000 after 10 years, this is your investment. Now, did you understand, Bhargav and Isha? Hello?
Yes, sir.
Yes.
See, I don't know what you understood. You do on the calculator and confirm me. Isha, do you know how to use the calculator?
Yes, sir, but I was using now.
Okay, use it and tell me, come on fast. Bhargav, you also calculate and tell me, we'll move forward fast.
So then what is 8%?
Yield to maturity, I by Y. 8% is your discount factor, right? The future cash flows will be discounted with this 8%. 10% is your coupon rate. That is the interest that will be paid. Both the methods. This is what the curriculum review says to follow. Okay, they are not of the opinion of using all these finance calculators. Schwezer, the metal what we are following, uses finance calculator. So it is better to explain you both of them, right? Done, Bhargav? Hello?
One second, sir.
Isha, have you done the calculation?
No, sir.
Then please do it. Do it right now. Do the method number 1, method number 2. If you are finding it difficult, then shall I see App Store in the? Shall I install App Store in the laptop and and see the calculators available or not?
Sir, I
Yes.
got it.
Okay, you want it, Isha? Okay, we'll see. If it's available, then we'll go ahead. I don't know Microsoft Store has it or not. I don't think these guys have. Okay, Isha, I'll just tell the instruction to you. Did you download the calculator which I said right now?
Yes, sir.
So you just open your calculator and see the function second. Did you see the function second
Yes.
in the second row extreme left? You saw that, right? You click on that second. Then third row extreme right, clear TVM, click on that. Did you click?
Yes, sir.
And then you come down last extreme left, clear work. Click on that. You see all 0 zeros, right?
Uh, yes, sir.
Like last row, extreme left, you have clear work, CE by C. Did you click on that? So you have all 0 zeros, right?
Yes, sir.
Now you click 10. Did you click 10?
Yes, sir.
Then click on N. You got N is equal to 10.0000, right?
Yes, sir.
Then you click on 100 and then click on PMT. So PMT is equal to 100.0000. You can see that, correct?
Yes, sir.
Then you click on 1000 and then click on FV. So you have FV is equal to 1000.0000.
10,000.000.
No, it is 1000.0000. You may have clicked on 10,000 maybe.
Yes, yes. Okay, okay. Yes.
Did you click now?
Uh-huh.
Then you click on 8 and click on I by Y.
8, yes.
And then you click on the like the top row CPT, extreme left, compute, and then come to third row and in the middle PV, you'll get minus 1134.20. Did you get this?
Yes, sir.
Understood? Okay, let's move forward now. See, now we are going for the next concept, that is present value of perpetuity. Now, what do you mean by perpetuity? See, in UK, there were certain bonds which were issued by certain companies like, British Petroleum or British Telecom. So what they did is they asked the investors to pay a sum of money to them, and for that the British Telecom or British Petroleum, whoever has issued such kind of bonds which are perpetuities, they will pay a fixed amount for the entire lifetime till the time the lenders are alive. That means for the infinite period of time they will pay a fixed amount. Okay, so how it goes, I'll tell you. Let's say present value of perpetuity. That means if $10, let's say if $10 the company has promised to pay to the lenders for the entire lifetime at the rate of 0.10, that is 10% rate. This is called 10% rate. At a rate of return of 10%, if the company British Petroleum is ready to pay $10 per annum till the entire lifetime of a person or for the infinite period of time, okay, then how much the person would have invested today? $100. Did you understand? This is nothing but the present value of perpetuity. This is what you have invested to get this amount at the rate of this, or else if I multiply this 0.10 with $100 right now, I get $10. That means at the rate of this return, I have invested this to get this amount for my entire lifetime. Did you understand? Yes or no in chorus? Yes.
Yes, sir.
So they haven't given any question now. If they have given, I would have explained you, but the questions have not been given. So I have the old book PDF. I'll share with you. If you want, you can try such question from that book. Okay. This is a new book, new PDF, new material. So some changes. Now, next comes amortizing bond. What do you mean by amortizing bond? See, every year bond, whenever you know, like, let's say you are buying a bond, or let's say you have taken a housing loan. So housing loan, let's say you have taken a 40 lakh rupees and you open your Google. Come on, all both of you open your Google calculator. Sorry, you open your Google search and then on that you type SBI home loan calculator. Type it. Did you type? I'm asking something. Did you open your Google search?
Yes.
Hello. And on that, have you typed SBI home loan calculator?
Yes.
There is a home loan EMI calculator SBI. Just click on that. Isha, are you doing this? Hello.
Yes.
Isha, I'm asking you. Yeah, this is a different world, Isha. And this world is more informative. Okay. So home loan amount, just put 40 lakhs. Let's say you are taking a home loan of 40 lakhs. 75, you have 75, right? Remove that 75 and put it as 40 lakhs. Did you do that?
Yes.
And let's say if you are young people, so 30 years is what you can get as a maturity period to pay that loan amount. And let's say the home loan interest right now as on today is 9.55%, of course. So you see down, your EMI amount is 33,780, correct?
Yes.
You have taken a loan of how much? 40 lakhs, and you are paying an interest of how much? 81 lakh 60,867. If you are continuing this for a period of 30 years, are you seeing that?
Yes, sir.
Yes, sir.
What did you understand? If you take home loans, this is the case. People pay double the amount of interest when compared to the principal amount what they have taken. But again, you will be having a question. Then, sir, if home loan is such a thing, then why I shall buy a house by taking a loan? See, if you don't take a loan and don't buy a house in your young age, when you become older, let's say today, I can give you an example. Today, if I want to buy a 2 BHK flat in Hyderabad in a gated community, it is available. Say, gated community concept is a new concept. It's in trend since 4 or 5 years. What I'm saying, almost 4 or 5 years in Hyderabad. It's trending a lot. So today, all in all, with all furnishing, a 1100 SFT flat apartment is available. Is if you want to buy in Aparna or such kind of complexes, such kind of builders, they are charging around 7,000 plus in outskirts. So your base price is around 75 lakh with GST and all, 75 lakhs. See, first what they'll do, they'll take the SFT into, see, all these are information for you, important information, into 7,000 rupees per SFT, let's say. Okay. So how much? Calculate. It will be 70. How much? 77 lakhs. Correct or wrong? Hello.
Yes, sir.
What are you doing? Why you people are not answering my questions? Yes, 77 lakhs. Bhargav, are you calculating?
Yes, sir.
So 77 lakhs is the, just a second. So 77 lakh is the price of the apartment. You have to pay a 30% down payment. You understand? Okay. Or let's say 25%. Okay. So like whatever that is okay. That's not the criteria here. So this apartment you have to add GST. So GST is 5%. So how much is the GST? 3,85,000, right? 77 lakhs plus 3,85,000. See, this is why I am explaining this concept. This concept is important from the perspective of amortizing loans. So this is GST 5%. This is the flat cost base price. So it is 80 lakhs 85,000 it is costing you today's scenario. And then you have stamp duty and registration charges 7% around. That is 5,65,950. So before buying a flat, it's not only the down payment. You should know all these factors as well. 86 lakhs 50,950. See how the escalation comes. Almost 9 lakh rupees plus here. Okay. And then apart from this, this is what I'm speaking about, area which is in outskirts of Hyderabad. That is likes of Kompalli or Kukar or like, you know, Miapur, etc. And after this, then what you have to do? The builder will charge somewhere around 1,60,000 to 2 lakh rupees, like corpus fund, 2 lakh rupees, let's say. So it becomes 88 lakhs 50,950. And not only this, sorry, I just forgot one more thing. You know what I forgot? This was the base price, but I did not add the amenities. So they are charging somewhere around 10 lakh for amenities, and then again GST of 5%. So 10 lakh 50,000 you can add up at the end here. They are giving you gym, swimming pool, and like squash court and banquet hall, everything. So now you add. So to get all this, you need to study well, you know. You have to work hard to achieve all this. 99 lakhs 950. That is, if I convert into dollars today, if the dollar price is $1 is 85 rupees, you have to spend 1,16,481 dollars to buy a apartment, 2 BHK apartment in Hyderabad in a gated society. Is it a small amount? No, it's a very big amount. And then you have to pay maintenance for the entire lifetime. So why I'm saying this is what is the pricing structure of an apartment. So now you see if you are taking a loan of how much? 40 lakhs, right? But do you think you will be taking a loan of 40 lakhs? No. If the flat is 80 lakhs 85,000 something plus 10 lakh 50,000, I'll add it here. So the entire flat, I did not include interior cost. You will spend 10 lakh rupees minimum for interior. So it will go around 1 crore 10 lakh rupees. 1 CR and plus 10 lakh rupees to buy a apartment in Hyderabad. That is what is today's condition. Okay. So 77 lakhs plus 10 lakh 50,000. No, 77 80 lakhs 85,000 plus 10 lakh 50,000. It comes to 91 lakhs 35,000. Of this, you opted for 25% down payment. So 22 lakh rupees, 22 lakhs 83,750 you have to make a down payment. So 91 lakhs 35,000 minus 22 lakhs 83,750. If I remove 68 lakhs 51,250 you have to take a home loan. 68 lakh 51,250. That's the condition. So if you take a home loan of this much, 61 lakhs. No, sorry. 68 lakhs 51,250 68 lakhs 51,250 for 30 years. 57,859 will be your EMI, monthly EMI, and you will be paying an interest of 1 crore 39 lakhs. That means more than double the amount of this. Are you understanding? Please tell me.
Yes.
I don't know whether you're understanding or not. So let's keep it simple. You type 40 lakhs on the SBI home loan calculator. 40 lakhs if you are spending, 40 lakhs if you are taking as a loan for a span of 30 years, you are paying 81 lakh rupees interest. And come to the like the loan amortization schedule. There is a table 1, 2, 3, 4, 5, 6 every month. You are seeing a table, right? Month 1, month 2, month 3, month 4. Tell me yes or no.
Yes, sir.
And
Yes,
in that, what are you seeing? There is a EMI of 33,780, which you are paying as a fixed amount for your entire span of 30 years. 30 years will be 360 months. 30 years will be 360 months. For 360 months, the EMI will be fixed amount, but you know, it will be a combination of principal and monthly interest. You see, the principal is very less in the beginning years and the monthly interest is 31,833. Okay, and then when you see the outstanding amount, how you get the outstanding balance? You should remove that principal amount of 1947 from 40 lakhs and then you will get 39 lakhs 98,053. Do that calculation. Shall I open that SBI home loan calculator in this? I'll do that. I wanted to explain you the concept of amortizing loan. So amortizing loan goes in this way. This is 40 lakhs for a span of 30 years. If I take for an interest of 9.55, I see that I am paying an interest of I am paying an interest of 81 lakh 60,867. Okay, for a loan of 40 lakhs, I am paying double the amount as interest. The total amount what I am paying to the banker for a span in like after 30 years is 12 lakhs 1 crore 21 lakh 60,867. I am paying, and how it goes, how the loan is getting amortized. That means how the loan is reducing every time. The loan will always reduce with the help of the principal payment being deducted from the loan balance. So this is the loan balance. 40 lakhs is the loan balance. This is the monthly EMI. This is the principal amount. Now you should not ask me how did they calculate this and this. It's a very complex calculation, not there in your syllabus. Just I wanted to explain you the amortization schedule of a loan. And this is the monthly interest. So 31,833 plus 1947 is 33,780. This will be fixed for 30 payment for 30 years. That is 360 payments. You can check here. See. So I am into the 360th payment. And what difference you will see, I'll show you. In the first payment, the principal amount was 1947, right? In the last payment, the principal amount is 33,513 and the interest amount is 267. In the first payment, the principal amount was how much? 1947 and the interest amount was somewhere around 33,000, right? Right? So that shows in the earlier stages, the bank will take maximum amount from this 33,780 payment, which is called EMI, easy monthly installment. During the initial years, they'll take maximum amount of interest and very minimal amount of principal. But at the end of the loan term, Maximum amount will be principal in this and minimum amount will be interest. So that's the reason they say if you want to repay home loan, repay it like in 1 year or 2 years. If you are delaying it for 5 to 6 years, they must have collected lot of amount as in interest from you. If I see the interest here, it's almost 31,000 going till, if I take 5 years, 5 years is 60 installments. So in the 60th installment, my principal is still 30,672. So if I take on an average every month 30,000, so yearly 3,60,000. In 5 years, I would have paid 18 lakh rupees as interest. So then what's the use? So loan amortization schedule is, now you take your calculators and in calculators, you just do the calculation what I'm saying. 40 lakhs is your loan amount. This is your EMI. This is your principal. This is your interest. If you want to get the outstanding balance, you subtract this principal from 40 lakhs. So if I subtract that principal from 40 lakhs, 39 lakhs 80,000, 39 lakhs 98,053. What is the meaning of this is this interest what you are paying has gone in vain, of no use, useless. Only what is getting deducted from the principal is, from the outstanding loan amount is the principal amount. That's it. This is what matters. So this is the only thing which can reduce your loan amount. That's the reason why they say you make yearly payments of 1 or 2 lakh extra payments, or you increase your EMI payment. That means you just increase your principal payment so that your loan will get reduced very sooner, because this interest is the payment which has gone in vain. Only this is going to reduce your balance. So again, your outstanding balance is 39 lakhs 98,053. This is the closing balance of the first year. First month becomes the opening balance of next month. Next month's your principal is 1962 because some amount has got deducted from this and the outstanding loan balance has decreased. On this again your interest will be calculated. So 39 lakhs 98,000 in 053. So again they will be the interest will be calculated on this. Okay. So it will be coming. So they will be calculating the total interest and they'll be dividing by the total number of months. That's a complex calculation. So again 1962 is what is your principal. Again this will be subtracted from this. You get the outstanding balance here. Again this will be the next month's loan amount, opening balance. Again you have to remove the principal. Again you get the outstanding balance. So in this way it will be going on. Okay. This is called the loan amortization. So now let's understand one question here. Okay, let's calculate. Follow up. An amortizing bond is one that pays a level amount each period, including its maturity period. The difference between an amortizing bond and fixed coupon bond is that an amortizing bond, for an amortizing bond, each payment includes some portion of principal. As I said you right now, the coupon bond will only pay you coupon. See, let's say that what's the difference between a coupon bond and amortizing bond, right? So I'll write here coupon bond, amortizing bond. The only difference between these two is this will be paying coupon every year. Let's say this is a 5-year bond. This is also a 5-year bond. So this bond will 10% is the coupon rate, $1,000 is the face value. This one also 10% is the interest rate. Okay. But here the difference between these two is they will be paying, this bond will be paying you coupon for the first year, second year, third year, fourth year and fifth year. They'll be paying you the entire amount. That is $1,000 plus 10% of that is 10. So 10 plus 1,000. It will be paying you in this way. Amortizing bond will pay you a fixed payment every month. Okay. Fixed payment every month. Let's say they have just calculated a fixed amount as 110. Let's say no, 205. Okay. Or let's say 202. Okay. What will happen? So 200 into 5 times. How much is that? Please tell me.
Yes, sir.
Hello. It is same 1010, right?
Yes, sir.
Yeah. So they have made this amount as an amount, fixed amount. This 202 is nothing but it has principal and interest element in this. Okay. So just a small example to explain you. That's it. That's the only difference between amortizing bond and coupon bond. Now next concept is amortizing bond are an example of annuity instrument. For an annuity, the payment each period is calculated as follows. This one. See how I can say that amortizing bonds are annuity instruments. Can you see this? Are you paying a fixed amount every year or not for home loan?
Yes, sir.
Yes.
When there is a fixed amount, when you are making a fixed amount to home loan, this can be termed as annuity or not? Come on, tell me.
Yes, sir.
Yeah. So Isha, you remember the concept of present value of annuity and future value of annuity or not?
Yes, sir.
Are you sure, Isha? I'm not. You're not sounding so confident.
No, sir. Not well.
Are you stuck up somewhere today?
I don't know.
Just a second. Just a second. Okay. So Bhargav, you understand the concept of annuity, right? Bhargav?
Yes, sir.
Hello. So yeah, so I will write the two like formulas for present value of annuity and future value of annuity. See, you know, like the discount factors which you have every year. Like say, let's do a small example. Let's say you have invested $100,000, okay, and you are expecting return of 10% every year. So first year cash flow is 10,000, second year cash flow is 20,000, third year cash flow is 30,000. In this case, we can use the discount factor 0.9090, 0.826, 0.751. Okay, let us keep it 3 digits. Multiply this one.
1 second. So first one is 9090.
I did it.
90. Yeah. Yes, sir.
So in this way, when you add this all, you get the present values. If I tell you you are investing $100,000 and you're getting a fixed amount of 10,000 every year. So in this case, what you'll be using? You'll be using this method, old method, or annuity method.
Annuity method, sir.
So your annuity will be the summation of all these discount factors, right?
Yes, sir.
So let's say if I'm doing the discounting here, just add them and just tell me the values here. Simply I can write 9090, 8260, 7510, right?
Yes, sir.
So when you add, you just add them, Bhargav.
24,860, sir.
So instead of doing this, what I will do is I'll add this discount factors.
Yes, sir.
I'll get 2.486 and this 2.486 into 10,000 will give me what? The same amount?
Yes, sir.
So what we understand is the summation of present value factors is equivalent to annuity factor.
Yes, sir.
Write on the formulas. I'll give two formulas to you: present value of annuity and future value of annuity.
Yes, sir.
And how to use it we will do when we'll get some questions or scenarios. Right, as of now they haven't given any scenario, so I'm also not using that concept. They have done all the mess up actually. I don't know what changes they have done, but it's a messed up one now. So that 2.486 what we got, right? Can you just
Yes.
calculate this and tell me in this formula? Can you put in this formula and tell me?
Yes, sir.
Yeah, just try to calculate. What are you going to do? You are going to take NS3. You're going to take IS 0.10. You're going to take CS 10,000, right?
Yes, sir.
C is the cash flow. So 10,000 to 2.486 is 24,860. I is 10, N is 3. So try to get it.
Yes, sir. Sir, 9,100, sir.
What? No. 1 minus 1 plus 0.10 whole power minus 3 whole divide 0.10.
I
So we'll
didn't take it -3, sir.
then you should do minus 3, right? Do it, do it.
Yes, sir. 1 second.
Yeah, yeah.
Sir, I'm actually not used to this BA calculator.
Okay, okay. You can do, no problem.
Sir, 24,860.
Sorry.
24,860.
Yeah, same thing you got, right? Okay, good.
Yes.
Let's go for the next one.
But are we allowed to carry a normal calculator in the exam?
You can carry, but you will be having the finance calculator, right?
Finance.
So no
Yes,
need to
sir.
carry.
It's just that I'm quicker with the normal one.
Everyone is big. You will be getting habituated with this finance calculator as well.
Yeah.
It will take some time.
Yes.
That's it. It's a matter of some couple of days. You'll learn it.
Okay.
So now we are doing a question, computing a loan payment. Suppose you are considering applying for a $2,000 loan that will be repaid with equal end of year payments over the next 13 years. Are they speaking about annuity?
Yes, sir.
Yes. So
Yes.
suppose you are considering applying for a $2,000 loan. You will repay, that will be repaid with equal end of year payments for next 13 years. That means FV is what? FV is what? FV is
2000.
what we need to know. We need to know. Nothing is
We
there
need to
because
calculate the future value, sir.
yeah, no. You need not calculate future value. They're not asking that. They're asking how much are your payments? They're asking you PMT.
PMT, sir.
I'll open one more page. This is not tidy one. That's the reason why it's creating a fuss. Just a second. Yeah, now it's very clear. So suppose you are considering applying for a $2,000 loan. So you will get a $2,000 today itself or not? Come on, tell me.
Yes, sir. We'll get it today.
So your present value is $2,000. Since it's a present value, it will be subtracted. Okay, it will be it's always considered as an investment. So it is always an outflow. Okay.
Okay.
Because it's like you're investing today, right? So because whenever I speak about present value, some outflow will be there. Suppose you are considering applying for a $2,000 loan. Yes, that is the present value. And that will be repaid at with equal end of year payments over next 13 years. So I can say N is equal to 13. Okay.
Yes, sir.
And annual interest rate. So I can say the I by Y. If the annual interest rate for a loan is 6%, 6, right? Then they're asking PMT is equal to question mark and there's no future value. They're not saying that you will be repaying the amount after 13 years and the repayment what you'll be doing is so and so X amount. Nothing has been mentioned. So FV is 0. So can you just do the calculation?
You want me to use the formula?
Yes. No. You have to use that calculator.
Yes, sir. 1 second.
These instructions are for calculator, but one thing you should be knowing. So you have to go for second clear TBM, clear work. You have to first type on plus or minus, or else let's start with this 13. Click 13 and click N. Then
Yes,
click 6 and click I by Y. Then you have to click plus or minus, Bhargav.
Yes, sir.
And then you have to click to just a second. No. Just again, second clear work TVM, clear work, second clear work TVM, clear work. I'm typing once again 13 N. Okay. 6
Okay.
I by Y. I clicked. Okay. Okay. Then
Yes,
I'll
sir.
be clicking 2000. Then after clicking 2000 plus or minus will give me minus. Did you click that?
So wait, plus or minus.
Down
I just
last
need to click on
last row, last
sir,
row
yes.
reset. Yeah, click. You got minus 2000.
Yes, sir.
Click on PV and
Yes.
then you have to click on 0 and click on FV and then you have to click on compute PMT. You'll get 225.92. Got it?
Yes, sir.
That's it. Okay. Why to use all those function calculations when we have calculator? We can do that, right?
Yes, sir.
Shall we move forward?
So what does I by Y mean?
Rate. This is discount factor.
Okay.
You will be discounting the future cash flows, right?
Yes, sir.
That is I by Y.
Okay.
Discount rate, discount factor.
Yes, sir. Yeah.
A coupon is not taken as I by Y, right? Did you did they mention anything about coupon here? Nothing. They have just mentioned about the rate.
Yes, sir. So usually rate of interest is the discounting rate, and coupons are usually taken as.
Yeah, coupon will give you the PMT. That coupon, the $10 every year is PMT. Nothing like
Yes,
nothing
sir.
like that. It is there to calculate the interest amounts. Okay.
Yes, sir.
Now we are going into equity securities. So we have preferred stock. You know everything about preferred stock, right? Preferred stock is nothing but preference share, whereby
Yes.
the preference shareholders get the preferential rights. They get the dividend at fixed rate. Point number one, they get the dividends at fixed rate and their money has to be redeemed. Okay.
Yes.
And more profits or less profit doesn't matter. They get their dividends at fixed rate. That is for sure.
Yes, sir.
Now this is the preferred. Now if you want to find out the preferred stock value, this is the formula. Dividends from the preferred stock divided by the cost of capital or cost of preferred stock. See, I already explained you if you want to find out the stock value or bond value, the formula is present value of future cash flows. Is it right?
Yes, sir.
So if you want to find out the preferred stock value, your future cash flows are dividend payments. Am I right?
Yes, sir.
And the discount factor what you're using or taking to discount this future cash flows of dividend payment is nothing but the cost of preferred stock. Cost of preferred stock is nothing but
The dividend paid.
yeah, if you are dividend or there can be different types of costs. Dividend is one of them. So
Okay.
the cost of capital or cost of preferred stock is nothing but it is the required rate of return what an investor would want from a preferred stock if they invest in the market as on today, right? So what is the
Yes.
required rate of return? That is represented by KP. Okay. So
Yes.
if you do this, you'll get the present value of the preferred stock. So here, very simply, what is the dividend payment? $5. What is the required rate of return? 8%. So $5 divided by 0.08 can give me the value of the preferred stock, 62.50, right? Hello.
Yes, sir. Yes.
Do this, finish it off. If you're done, shall we go forward?
Sir, I had one doubt. That is the interest pay in the previous time value of money.
In what interest pay?
In the previous slide when we were doing the calculation for the loan question. That time 6% is the interest paid, no sir. So how are we actually considering that as a discount?
See, in this question, did they anywhere give that you have taken a loan for so and some rate? Did they give that? It's a low $2,000 loan at the rate of 5% or something. Did they give that?
No sir.
That's
So they
what
gave
that means.
the last sentence, no sir. If the annual interest rate for the loan is 6.
I'm coming for that. If the annual interest rate for loan is that means the prevalent rate in the market is 6%.
Okay sir.
That's what.
Yeah, I got it.
Yeah. If you're done with this, shall we go forward?
Yes sir.
Okay, Bhargav, I'll stop here. Why? Because again, there's a lengthy explanation of the next topic. We'll do it tomorrow. Okay.
Okay sir.
Yeah, almost 1 hour is done because I have one more class right now. Okay, then we'll meet tomorrow and we'll finish it off. Don't worry. Tomorrow is the
Yes.
last class for time value of money, or if ratios take anything, tomorrow is the conclusion of any of the topics. So by this Sunday or by Sunday, if possible, I'll try to take, or else Monday, 2 chapters will be done. We'll move to the next
So
chapter. Okay.
tomorrow we have a class or Saturday?
Yeah, tomorrow I'm taking Bhargav tomorrow. I'm taking
Okay.
tomorrow.
Sir,
Yeah.
and one more thing I wanted
Because
to
I
know.
want to conclude this. Yeah, tell me.
Yes, yes. The timings are around 8 o'clock is fine, 8 to 9, because if it gets a little late, like 8:30 to 9 or around 9 to 10, I kind of miss my dinner in PG. So,
Oh, okay, dear. Fine. I'll make sure that one. Don't miss your
okay.
dinner, please.
Because around 8 to 9, 9:30 is fine, sir. A little later than
No,
around 10.
8 to 9. No. Don't skip your dinner and don't miss it. That's important. I'll do it on time. 8 to 9. Okay. At times, if
Oh,
I come somewhat late, I'll inform you.
okay, sir.
Yeah, I'll make sure it is early. Okay. Thank you, dear. Bye.
Okay, sir. Thank you.
Thank you.